1. Post-labor economics and its timescale. Post-labor economics broadly refers to a future economic system where automation, AI, and decentralized networks reduce or displace traditional labor roles. The pandemic accelerated automation adoption, and advances in AI DLT are further pushing us toward less reliance on human labor in many sectors.
Time frame: we are currently in a transition phase, early 2020s through mid-2020s, where post-labor concepts are still nascent but rapidly maturing.
Real systemic shifts likely take 5 to 15 years to fully unfold at a macroeconomic level. 2. The 2025 bull run. Are we entering a new era? Historically, crypto bull runs happen in roughly 4-year cycles. Bitcoin halving cycles in 2013, 2017, 2021. The 2025 bull run is often anticipated as the next major surge following the 2020-21 boom. However, this time the ecosystem is more mature, with stronger infrastructure, institutional involvement, and clearer regulatory frameworks. Post-2021 market behavior suggests a longer accumulation phase with less brutal crashes but rather plateaus and corrections, potentially signaling a new era of greater market resilience. Key factors supporting a new era: more robust DeFi protocols with layered security and better UX, regulatory clarity increasing institutional confidence,
expanded use cases beyond speculation, e.g. gaming, identity, tokenized real assets,
interoperability across blockchains reducing systemic risk.
3. DLT adoption for DeFi, Sfin, and XFi. Is it here to stay?
DLT, blockchain and distributed ledgers, are no longer experimental. They underpin many critical innovations. DeFi, growing steadily with more capital locked, higher TVL, and diverse financial products, lending, derivatives, insurance.
Sfin, social finance,
emerging strongly, integrating social media, creator economies, and financial incentives, NFTs, social tokens. This drives organic network effects and broader adoption. XFi, exotic finance, includes novel financial instruments enabled by DLT, such as fractionalized ownership, real-world asset tokenization, and programmable money. Niche but high growth. Will DLT-powered DeFi, Sfin, and XFi avoid massive dips? While market volatility is intrinsic, the next cycles could have smaller, less severe dips due to greater market maturity and liquidity, improved risk management and smart contract auditing, stronger regulatory compliance reducing black swan events, broader institutional adoption stabilizing flows, increasing user trust and understanding. However, external macroeconomic shocks, interest rates, geopolitical events, will always impact sentiment. 4. Summary and outlook. We are likely entering a new era where blockchain DLT adoption in finance is more entrenched and resilient. The 2025 bull run may differ from prior cycles. It could be more sustained with fewer extreme crashes, but still with some volatility. Post-labor economics and automation will reshape demand and value creation, reinforcing decentralized finance models that automate trust and reduce intermediaries. DeFi, Sfin, and XFi are becoming core pillars of a new financial system, making massive dips less frequent and less catastrophic, but not impossible. Long-term, this suggests greater systemic stability and sustainable growth for crypto financial ecosystems, anchored by real-world adoption and integration. Let's dig deeper into the most impactful factors shaping this new era for crypto, DLT, and the 2025 bull run. Focusing on regulatory evolution, institutional adoption, technological advancements, and macroeconomic dynamics, and how these will influence market stability and growth. 1. Regulatory evolution, the gatekeeper to mass adoption. Why it matters. Regulation shapes trust, legitimacy, and capital inflows. Current trends. Governments and regulators worldwide are shifting from outright bans or hostile stances to clearer frameworks. The US SEC or CFTC, EU's MiCA, Markets and Crypto Assets Regulation, and Asia's regulatory sandbox approaches are creating guardrails. Increased regulatory clarity means more institutions and retail investors will enter with confidence. Impact. Reduced volatility. Regulatory frameworks help prevent scams, hacks, and rug pulls that historically cause sharp crashes. Innovation-friendly compliance. Projects that align with regulations can onboard billions in institutional capital. Cross-border legal interoperability. Critical for DeFi and XFi products that span jurisdictions. Potential risks. Overregulation or fragmented global policies can stifle innovation,
or push activities underground, creating black swan events. 2. Institutional adoption and integration. Why it matters. Institutions bring deep liquidity, long-term capital, and risk management practices. Key drivers: traditional finance, banks, hedge funds, family offices, increasingly use DLT for asset tokenization, settlement, and exposure to digital assets. Companies like BlackRock, Fidelity, JP Morgan, and others are launching crypto funds, custody services, and blockchain research. Stablecoins and central bank digital currencies, CBDCs, provide a bridge to traditional fiat systems. Impact: greater liquidity and price stability. Institutions provide buy and hold capital, reducing panic sell-offs. Better infrastructure. Custody, auditing, insurance, and compliance services make it safer for large players. Broader product innovation. Hybrid models, CEFI plus DeFi, tokenized bonds, derivatives, and exotic financial instruments. Outcome: the market is less likely to experience the same boom and bust cycles driven solely by retail speculation. Higher entry barriers for bad actors due to institutional scrutiny. 3. Technological advancements and interoperability. Why it matters. Faster, scalable, secure networks enable real-world DeFi, Sfin, and XFi adoption. Breakthroughs to watch. Layer 2 scaling solutions. Optimism, ZK rollups, Starkware. Drastically lower fees and increase throughput. Cross-chain bridges and protocols, Cosmos, Polkadot, Layer 0, enable asset and data movement across blockchains. Improvements in smart contract security and formal verification reduce vulnerabilities. Integration of AI and decentralized oracles for real-time data feeds enhance XFi product sophistication. Impact: user experience improves. Lower fees and faster transactions attract mainstream users. Complex financial products flourish. Programmable money enables automated, transparent exotic finance instruments. Resilience to systemic risk. Multi-chain ecosystems reduce reliance on any single platform. Outcome: this tech foundation supports sustained growth and resilience, mitigating risks of sharp systemic failures. Opens up new markets like fractional real estate, on-chain insurance, and social tokens monetizing influence. 4. Macroeconomic and geopolitical dynamics. Why it matters. Global interest rates, inflation, geopolitical tensions affect investor appetite for risk assets, including crypto. Current landscape. Inflationary pressures and monetary tightening cycles have pressured all asset classes. Crypto is increasingly seen as a hedge against inflation and financial censorship. Geopolitical tensions accelerate adoption of decentralized finance in regions with capital controls or currency instability. Impact: crypto as digital gold narrative strengthens, encouraging institutional and retail accumulation. Regional adoption spikes. Countries facing sanctions or banking restrictions rely on DeFi Sfin for financial inclusion. Market volatility persists but is less isolated to crypto and more correlated with global macro trends. Outcome: cycles of volatility continue, but crypto's role as a financial utility grows, making crashes less catastrophic. Long-term accumulation driven by fundamental utility rather than speculation. 5. Cultural shift and network effects. Social finance, Sfin. Innovations, creator tokens, NFT communities, DAOs, create new economic participation models. These models foster stronger user engagement and loyalty than traditional financial products. As communities and social economies grow, value creation and wealth distribution become more decentralized. This community-centric growth drives organic resilience against market shocks. Final synthesis. The post-labor economy, combined with maturation and regulation, institutional involvement, tech infrastructure, and macroeconomic trends, sets the stage for a fundamentally stronger, more integrated DLT finance ecosystem by 2025 and beyond. While some volatility and dips are inevitable, they will be less extreme, less frequent, and less damaging because of deeper liquidity, better tech, and clearer governance. This new era is characterized by finance as a programmable, inclusive, and global utility, far beyond the speculative playground of earlier cycles.